Believe it or not, there are worse things that happen in this world besides marriage. Hey guys, this is Chris for Hustle and Bustle, and today we're gonna talk about the 2008 financial crisis. After the tech bubble of the 2000s, investors were looking for a safe place to invest their cash. For mortgage lenders, these loans are a lot like bonds with benefits. Pun intended. Investing in mortgages, you receive regular interest payments, and if the borrower defaults, you take possession of the house, which is pretty nifty since the real estate market is always increasing in price, and that makes it a very good investing opportunity. Investors like me buy single-family houses for like $100,000 to $300,000, for example, but the investors we talk about don't buy individual houses because they work with, let's say, a little bit more capital than me. Here is where investment banks come in. They can buy a lot of mortgages from lenders and pool them all together and sell shares to investors, and that's known as mortgage-backed securities, which basically means that now the home buyers pay the investors their mortgage payments. And that's not all. The banks are not the only star of the show. Fannie Mae and Freddie Mac, which are government-sponsored corporations, they also started doing the same thing. So very quickly, lenders have extremely high demand for those mortgages, which is great. More mortgages sold on the mortgage-backed security market means the lenders made more money on that deal and got their money back, which they can lend again to a new home buyer. So lending and home buying skyrocketed. Investors and investment banks are getting richer, but now insurance companies joined the feast. They began to sell something called credit default swaps. A credit default swap is a financial swap agreement that the seller of the CDS will compensate the buyer in event of debt default or other credit events. That is, the seller of the credit default swap insures the buyer against some reference asset defaulting. Basically, those are derivatives that pay out if a mortgage borrower defaults. And because they were speculators in buying those CDSs, why not sell 5 or 10 policies instead of one? And as long as we don't get a real estate crisis, it all will be good. So soon the amount insured goes from $900 billion to $600 trillion. And 900 billion is that 90 followed by 9 zeros, and 600 trillion is 600 followed by 12. And everything is rainbows and unicorns for those lenders. If you're still watching, I will highly appreciate if you smash the like button, guys, and don't forget you can always watch the video on faster speed because your time is valuable. Also consider subscribing and learn more about the financial world and how to retire early. So I was saying that everything is rainbows and unicorns, but those mortgage lenders started to lose every incentive to avoid higher risk. At the end of the day, the demand for their product was so high, they couldn't keep up with the demand. So they started giving loans to borrowers with low credit scores and low income, also known as ninja loans. No income, no job, no asset. That's also known as a subprime loan. Also, some of those subprime loans are predatory, which means that on the surface they look good, but they're full with terrible terms and conditions. As usual, no one reads their contract, so most borrowers didn't even know what they're signing on. So soon enough, everybody and their cousin is buying a house despite having no way of paying the mortgage. And despite that, all mortgage securities are being rated as AAA, which is the highest you can get, because there are no really a regulation of who should rate them how. Basically, rating companies were rating them as they please. Investors didn't look into the whole basket of mortgages because there were thousands. And now we get to the CDOs, or collateralized debt obligations. So banks start selling CDOs, or collateralized debt obligations, claiming that they were virtually risk-free. They weren't. CDOs are similar to mortgage-backed securities, but they're riskier. CDOs are full of subprime mortgages. On top of that, people are using complex derivative investing called synthetic CDOs to bet even more that people will make their mortgage payments, which, if you haven't noticed, it's not very likely. What are synthetic CDOs? If you've seen the movie Big Short, Selena Gomez explains it very well. If you play a game of blackjack and say you have 18 and the dealer's shown 7, you have a pretty high chance of actually winning. Now, you are making a bet on that cards that you're dealt, but people behind you are like, hey, I bet that person will actually win. And they bet and they give somebody, let's say, 3-1, and that somebody takes that bet. Now, soon enough, that's party A that bets on you. Soon enough, party B bets on party A that their bet will become true, and party C and party D and so on and so forth. So soon enough, from one actual CDO, now we have 1, 2, 3, 4, or 10 synthetic CDOs that they're all tied up to the original CDO. I hope that makes sense. So now when the original CDO defaults, everybody on the chain goes to shit. Rating agencies that were supposed to rate the CDOs rate them at AAA, like I already said, instead of warning investors that shit's about to hit the fan pretty much. So what happened next? By October 2007, 3% of the US households are in foreclosure and 7% are 1 month past due. Foreclosed homes are flooding the market. I wasn't in the US at the time, but I hear stories that every street you drive had for sale sign at every house. So soon enough, supply is way more than the demand, and in 2008, housing prices started decreasing like your bank account after a divorce. So all those banks, rating companies, lenders, and so on take a big hit. In this video, I'm not going to talk about the bonuses that CEOs got before filing for bankruptcies, but despite 75% of the CDOs being rated as the highest safety rating, 70% of them defaulted, so there was a lot of bankruptcy. Even big guys like Lehman Brothers with 600 billion in assets goes down. Investors pull whatever they can and invest it in treasury bonds, which makes Dow Jones lose 1/3 of its value. Fun stuff. Companies that rely on loans are getting screwed. Countries tied to the US are feeling the effect. By 2009, the whole world can feel the financial crisis. I was in Bulgaria at the time. No one had any idea what this crisis means. People kept saying the world financial crisis, but when I asked, what does that mean? No one really can give me an answer. Yeah, I was a dick back then as well. So years later, I find out what exactly happened, but we felt it even in my country of Bulgaria. So 2010, the Dodd-Frank Act was introduced to crack down on lending practices like that. So hopefully whenever we experience, will never happen again. Thank you very much for watching, guys. I hope the video was clear and it helped you understood a little bit more what happened into the 2008 financial crisis. It is very important to know history so we don't repeat the same mistake over and over again. Thank you very much for watching. Thank you very much for supporting the channel, and I'll see you next time.